While most retail traders were staring at candlesticks and hype threads, the real turning point wasn't happening on a chart. It was happening behind conference room doors in Basel, Switzerland. That's where the Bank for International Settlements, the BIS, often described as the central bank of central banks, has moved Basel III into its final implementation phase, what many in the industry call the Basel III endgame. And this isn't being framed like a big public announcement. It's being treated like plumbing work, quiet, technical, easy to ignore. But the consequences are anything but small. Because as markets open on Monday, the banking system is being pushed into a different relationship with gold and silver, and by extension, the entire precious metals complex. In simple terms, for decades, banks could lean on paper metal, synthetic metal exposure, unallocated accounts, futures, derivatives, and treat it as if it carried the same safety as the real thing. Starting Monday, that assumption becomes expensive. And when something becomes expensive for banks, banks don't argue with it. They change behavior. And when banks change behavior, markets move. So today, I'm going to break this down clearly. What Basel III changes, what the net stable funding ratio, NSFR, actually pressures banks to do. Why unallocated metal suddenly looks like a problem on a balance sheet. Why the LBMA and the paper-heavy Western model faces pressure. And why this could be the beginning of a violent repricing, not driven by retail hype, but driven by the mechanics of regulation and bank capital. This is Global Money Alert. Let's get into it. First, you need one core concept. Banks are not free to hold whatever they want, however they want, with no consequences. They live inside capital rules, funding rules, liquidity ratios, stress tests, and these rules decide what is safe, what is risky, and what becomes costly to carry. For years, the system allowed a giant gray zone in precious metals, a world where a bank could hold metal exposure without holding much metal, a world where paper contracts and unallocated claims could be treated like reliable assets. That's where manipulation accusations, suppression theories, and decades of frustration in silver narratives come from. Because if you can expand paper supply endlessly, you can drown price signals. But Basel III reshapes that environment. Not through a headline, through balance sheet math. The net stable funding ratio is central here. NSFR is basically about the stability of a bank's funding. The regulators want banks holding assets in a way that's funded by stable sources, not fragile, short-term funding that disappears in stress. So under these rules, certain assets get treated as more dangerous to fund, and unallocated precious metals exposure, paper claims without physical backing, starts to look like a liability rather than a convenience. The rule doesn't need to ban paper metals. It simply makes them expensive enough that banks stop loving them. And once banks stop loving them, the paper metal machine loses oxygen. Here's what that does in practice. If a bank is holding a large short position in paper silver or facilitating paper silver exposure, the NSFR framework can force that position to carry heavier funding requirements, heavier capital, heavier balance sheet cost, more friction, and friction kills leverage. Leverage is what makes paper markets huge. So the practical effect is this. Banks become incentivized to do one of three things. 1. Reduce exposure to paper metal positions that carry regulatory penalties. 2. Move toward physical, allocated metal if they want to maintain exposure. 3. Step back entirely, letting those paper markets shrink. That's the first big shift. The second shift, and arguably the most bullish concept in this whole script, is the Tier 1 framing. Under Basel rules, Tier 1 assets are the gold standard of what banks can treat as strongest quality capital. In the narrative you're following, gold is being reclassified in a way that makes it more favorable, closer to risk-free treatment. If gold is rewarded and paper exposure is penalized, the conclusion is predictable. Banks stop acting like forced sellers. They start acting like strategic holders. And once the biggest institutions in the financial system switch roles from suppressing and providing supply to accumulating and locking supply, the floor price changes, not temporarily, structurally. That's the key. This isn't supposed to be a pump. It's a reweighting of incentives. Now let's talk about silver specifically, because someone will say, Basel III is about gold, not silver. And yes, gold is at the center of the capital framework. But silver doesn't need to be in the center to benefit. Silver is attached to gold through behavior, through hedging, through investor psychology, and through the broader precious metals trade. When gold gains status, Silver often rides the wave, sometimes quietly, then suddenly. Silver is the smaller market sibling. That means it takes less institutional flow to move it, and that's why this matters so much. If banks are discouraged from paper silver selling and encouraged to hold a higher quality collateral, the silver market can tighten fast. Because unlike paper supply, physical supply has limits, and silver has industrial demand sitting underneath it like a constant drumbeat. If you've ever wondered why silver narratives always sound like pressure building, it's because the market structure makes it vulnerable to sudden squeezes. Now, does that mean Monday morning is guaranteed fireworks? No one can guarantee that. But the rule change creates a deadline effect. Markets don't wait for the official calendar. They front run. They position. They reduce risk ahead of time. And that's why you see signals people interpret as overnight unwinds, thin liquidity, sudden gaps, and market makers stepping back. When a new rule changes the cost of carrying exposure, market makers don't keep quoting like nothing happened. They adjust. They widen spreads. They reduce size. They pull orders. And when enough large players do that at once, liquidity vanishes. That's what a liquidity vacuum looks like. Not a glitch. A withdrawal of willingness. If you saw weird moves last week, sharp gaps, odd pauses, sudden lack of offers, you can interpret that as players recalibrating ahead of regulatory math. The algorithm didn't break. The environment changed. Now let's address the elephant in the room. For decades, the silver community has argued that silver was suppressed through naked shorts and paper leverage. This script is saying Basel III is the death knell for that era. In the strictest sense, Basel III doesn't ban manipulation, but it can make suppression a lot harder to maintain if the cost of short exposure rises. Because if a bank has to hold significantly more capital against large short positions, the trade becomes less attractive. And less attractive is often enough. Banks are businesses. They don't do charity. If a trade becomes a capital hog, it stops being easy money. So when people name JP Morgan or Citi in this narrative, the argument is basically big short positions become painful, funding cost jumps, the carry cost skyrockets. It's not that someone suddenly grew a conscience, it's that the balance sheet starts screaming. And if banks start reducing short exposure to align with compliance, that reduction creates buying pressure, not speculative buying, mechanical buying, compliance buying. That's a very different fuel. Speculators come and go. Mechanics force action. Now add industrial demand. This is where silver becomes a battlefield. Because silver isn't just an investment metal, it's a manufacturing metal. Electronics, solar, medical devices, defense, high-end industrial applications. And some of the biggest companies on Earth cannot simply skip silver. If these industrial players see a world where banks step back from paper supply and physical becomes tighter, they have an incentive to secure supply contracts early. They don't want to compete with a banking sector that suddenly needs physical collateral, so you can end up with two vacuum cleaners chasing the same dust. Factories trying to lock in supply, banks trying to upgrade collateral, and the physical inventory isn't infinite. That's why the narrative frames it as a race, because it is. And if both sides try to act at once, silver can move faster than most people expect. Now let's talk about the global angle. This is not just a US story. This is not just a London story. This is a West versus East market structure story. The Shanghai Gold Exchange model is frequently cited as more physical and more allocated, a system that leans harder into real settlement. And in this narrative, China has already been operating in a Basel-aligned style, while the West relied on paper depth and unallocated flexibility. So the argument becomes the West is being pushed reluctantly toward a more physical standard. And by doing that, regulators are admitting something important. Paper derivatives create fragility. Physical collateral creates stability. So they are trading one problem for another. They may make the system safer long-term by reducing hidden leverage, but in the short term, they can trigger repricing events, especially in markets where paper exposure has historically dwarfed physical availability. Now, why should you care? Because if banks are pushed toward physical metal, they need to fund that shift. And funding is not free. If banks have to strengthen balance sheets with physical gold and silver exposure, they may be forced to rebalance other holdings. That's where the currency impact comes into the narrative. To buy more metal, banks may sell other assets. They may reduce treasuries, they may reduce dollar exposure, they may rotate reserves, and even if that's only a small shift, it can put downward pressure on the dollar over time. A gold revaluation in this framework acts like an indictment of fiat purchasing power because if gold rises as risk-free collateral, then the currency used to price it loses relative strength. In other words, if gold becomes a stronger anchor, fiat becomes a weaker one. Now let's talk about the part that hits individuals directly, unallocated precious metals accounts. If you hold a bank-based silver account that is unallocated, meaning you don't have title to specific bars, this rule framework can make your position unattractive to the bank. Because from the bank's perspective, it's an obligation, a balance sheet burden. So the incentive becomes close programs, cash people out, convert metal exposure to cash, reduce liabilities that carry penalties. And if that happens during a tightening physical market, you risk being cashed out at exactly the wrong time. You don't want to be forced out during a repricing. So the warning here is, if you don't hold the metal, you may not control the timing. And timing is everything. And here's another layer. The mainstream media rarely covers Basel III and NSFR because it's technical. It sounds boring. It doesn't trend. But these rules are the wiring behind the walls. Most people only notice the outcome, volatility, gaps, market stress, without understanding the cause. So you'll hear market turmoil. You won't hear capital rule incentives. But it's the capital rules that change the behavior of institutions. Now, the script compares this to Nixon closing the gold window in 1971. The point of that comparison is symbolism. 1971 marked a break away from metal as the core anchor. This narrative frames Basel III as a bureaucratic crawl back toward metal as collateral, not a full gold standard, not an overnight reset, but a gradual re-anchoring, a system quietly admitting debt is heavy, inflation is sticky, trust in fiat alone is not enough. So institutions prepare lifeboats, and in this script, those lifeboats are gold and silver. Now let's go deeper into London, the LBMA, and the unallocated loophole. The LBMA is often described as operating with massive unallocated volume compared to physical inventory. The criticism is that unallocated gold can be leased and rehypothecated, creating layered claims like a pyramid of paper on top of real bars. Basel III pressures that world because high-quality treatment becomes harder to justify without stronger backing. So if clearing banks must improve ratios, they may need more allocated physical metal. And if London tightens physical delivery demands, global vault drains accelerate, because the world's physical stockpiles are not sitting idle. They're already spoken for. They're already pledged. They're already part of supply chains. So if the system suddenly insists, prove it, allocate it, back it, the scramble begins. And when scrambles begin, premiums appear, spreads widen, dealer inventories vanish, and you start seeing sold-out conditions even while paper charts look calm. Because paper can pretend supply exists, physical cannot. Now we reach the derivatives layer. The script mentions the derivatives market and how collateral stability underpins everything. That's true conceptually. Collateral quality matters for leverage. If banks must use better collateral, leverage becomes more expensive. And when leverage becomes more expensive, forced deleveraging can hit. That's what this narrative predicts. Hedge funds relying on cheap leverage to short metals could face tighter terms. Higher rates, less access, short positions become less comfortable, and when shorts are uncomfortable, shorts cover. Short covering is buying, and buying in a tight market is gasoline. Now, sovereign wealth funds. The script argues that major funds in the Middle East and Asia have been anticipating this and front-running it. The key idea is big money positions early, then gets public later. Even a tiny allocation shift from huge pools of capital can move silver because silver is small. A $1 trillion fund moving 1% is $10 billion. Silver's market is not built to absorb that smoothly. So the point stands. The metal markets don't need everyone. They only need a few large players to shift behavior. Now the script also introduces a conflict. Basel III pushing physical collateral, CBDCs pushing digital control. It frames it as two factions. Whether you believe it's factions or simply different policy tracks, the idea is one side of the system wants stronger collateral. Another side wants more monitoring and control through digital rails. Both can be true at once, and if both are true at once, then physical collateral becomes even more valuable, because it's the one asset class that satisfies stability needs regardless of the digital direction. Now, audits. Basel III and tighter rules increase the pressure for verification. If regulators demand proof of allocated metal, audits matter. And the script suggests that any double counting, least metal treated as owned, could be exposed when audits arrive. I'll phrase it like this: if audits become stricter, any weak custody chain becomes a risk event, and risk events force buying of audit-proof metal, bars with clear title, clear custody, clear allocation. So the demand concentrates into the highest quality, most verifiable physical inventory, and that drives scarcity because not all metal exposure is equal. Now miners. The script says miners may sell directly to banks, bypassing retail. The idea is, if banks need physical, they can negotiate at the source. That's logical. And if that happens, retail availability tightens. Coin shops feel the squeeze. Premiums rise. Small buyers get priced out. And that fits the narrative of the window closing. Finally, the macro punchline. If banks are forced to hold more capital, lending becomes harder. This can reduce credit growth. It can tighten mortgages and business loans. A regulatory tightening can be deflationary in the real economy. But if the economy slows and policymakers respond with more liquidity, more stimulus, more printing, more intervention, you can get a mix that feels like stagflation. Slow growth, high prices, and in stagflationary environments, the argument is that hard assets perform well. So the script ends with a clear call: don't fight the direction of regulation. If banks are incentivized to move toward physical, consider aligning your exposure with what banks are being pushed to hold. If banks are incentivized to reduce paper leverage, don't be the last person holding paper claims that can be cashed out, because the rule change is the signal. Not the headlines, not the noise, the rule. So here's the close. Basel III is not a conspiracy theory, it's regulatory plumbing. But plumbing decides whether the house floods. And from Monday onward, the incentives change. Banks reprice risk. Paper metal becomes a balance sheet problem. Physical metal becomes a balance sheet asset. And when the biggest institutions on earth change incentives, markets follow. The paper era doesn't end because someone wanted fairness. It ends because the cost of pretending became too high. So the question is simple. If the banks, the regulators, and the system itself are quietly shifting back toward metal, as collateral, are you positioned like it's still 2015? Or are you positioned like the rules of 2026 are already here? This is Global Money Alert. Comment 1 if you think this is bullish for metals. Comment 0 if you think it's mostly hype. And tell me your country, USA, UK, Canada, Australia, EU, or other, because the currency impact looks different depending on where you live. And if you want the next video, I'll break down the LBMA unallocated system in plain English, how it works, where the pressure points are, and what allocation actually means. Because if you can understand the plumbing, you can see the flood before it hits.